Hello again, everyone. Welcome to the Options Mentor. Well, once again, the market continues to astound with its up moves. I don't believe, I was looking back a little bit, but I don't believe I've ever seen a rally of that magnitude on the Friday after Thanksgiving before. Not that it was a huge one, obviously, but normally the day after Thanksgiving is just very, very quiet. I was talking with an old floor trader the other day, and he told me that when he was on the floor, many times you'd see the market go up some on the day after Thanksgiving because short sellers take the day off. So the market just drifts up because there's really no sellers. And with some of that in play here, it's possible that the only interest was buying, just no one really to sell. So you saw it drift higher. But as we head into this week, we're heading into now, really the only big news, if you look at an economic calendar, is the non-farm payrolls on Friday. So maybe this week we can still have a more peaceful time. It may very well continue to rally, but it could be a situation where it'll be a little bit more back and forth as we get more volume. I mean, the volume in Thanksgiving week is traditionally very low. So we should see a return to volume here, most likely a Santa Claus rally going along. So we'll see how that goes. So let's take a look at the chart here. I want to start there. And as you can see, of course, we're around these all-time highs. We actually closed at 60.32, hit 60.44, and look at the VIX. It's pretty much in the cellar. Even if we look at a VIX chart over here, let's do that real quick. It is definitely in the lower part of the range, right? Has it been lower in the last year? Well, yes, but it has not spent most of the last year lower than this, right? We spent a lot of time above it, particularly the last 6 months or so have been sometimes very much above it. So we got a low VIX, probably a rally coming. So the VIX probably will stay safe, stable, could drift down a little more. But the good thing about a VIX, when you get this low in the 13s and 12s, it's unlikely to drop a whole lot more, right? I have seen the VIX in the 9s before. And certainly we could see something down in the 12s or even 11, but I think there's a little bit of a seller beneath us in the that's supportive in the SPX, a little more than it would be if we were at 18 or 20, as you could appreciate on the VIX. So being in this range, I know you guys have heard me say it before, my favorite trade in this range is, of course, the calendar. Why? Well, it has risk on both sides, but you get a little bit of room with it. And a lot of times in low volatility, it can be pretty orderly trading, a little less likely, to have huge moves. So that can really help you here. And plus, because of the bull market, the demand for calls is so high. If you use a call calendar, you'll see here that you do get a flatter lineup here. You're just not down as much. Let me compare this to a put calendar. So if I do this with a put calendar, traditionally over the last 20 years I've been trading these, you didn't see a whole lot of difference in the structure of this graph, whether you bought puts or calls. But over the last year or so, you absolutely do. Look at this. On the downside, you're down about 80 at the lower break even, down about 30. And if we do the calls, instead of puts, now notice the puts are 380, the calls are $5. You are paying more, but you're down about $100, 95 bucks on the lower. But look at this up on the upside. Upper break even, you're only down about $8, $8. So I think it makes sense here if you're going to do calendars and you're doing them in a market that seems to be like a zombie to the upside, then you could see the value of doing these with calls where you're flatter as the price moves up here. Now, was it the 17th and 18th? I believe in December, we will have a Fed meeting with a rate decision coming. So anything about that will, of course, weigh on the market. But I think if we go out here over the next couple of weeks, you'll probably see some upside and maybe some positioning for it. But I don't look for a crazy rally where we get a whole bunch over 6,100 or anything before that rate decision is more obvious that they're going to cut rates, because that's what the market's after. I'm not sure what the likelihood of that is at the moment, but we'll get a better look at that, and it'll probably change a fair amount over the next 2 weeks. As we get closer, the market will believe they have it dialed in what the Fed's going to do. Of course, they're looking for a quarter point additional cut. Perhaps we'll get that. I wouldn't be surprised in this particular environment. So as we look here, my idea for this coming week is a calendar. And I just modeled this one a little above what we're trading. We traded at 632 on Friday. And you could do it at 630. And of course, I wouldn't put this trade on until about mid to late session tomorrow. I like to let the market have a chance the first few hours to figure out what it wants to do a little bit. And then I place my trades. But if you do the 630, you do the 640, either one of those I think looks pretty good. Somewhere within 5 or 10 points of where we're trading should be fine. Then the idea with this is as it drifts up, maybe volatility would drop. And you're long Vega, that's not always good. But the deltas are in your favor, right? As we drift up, deltas will help you because you're making a little more money as you go up. So even with the vol drop, it'll be supportive that your calendar center is a little higher. So that will help you with your profitability. So let's go over here and talk about something here today I wanted to show you guys. And if we look at the 13th, and you'll notice, and I'll talk more about this in a moment, I did the 13th and the 17th, which is 4 days wide, of course. Now, let me get less strikes here so this doesn't look quite as crazy. Let's see. What if I did 6? That should probably do it. So if we do 6 strikes, you can see here at the 59.40, or excuse me, let's go up here to the 60.40. And we're going to make one of these here instead of, there it is, implied vol. So the implied vol of the 60.40 of the one you're selling would be 10.77%. So 10.77%. Now, how does that compare to the volatility or IV of the one that you're buying? So let's go out here to the 17th. And if we look at the 60.40, it is 10.2%. So really not a big difference between the two, whether you're doing the 60.40, 60.30, whatever it may be. There's not a big difference in the volatility between the short and the long. The shorts have a little bit higher volatility, as we see here. But the key to this is, the reason I showed this to you is because, yes, we're long Vega, meaning long volatility. Well, what does that mean? That means that every time volatility goes up 1 point in your favor, you would make $66.47. Well, it would be reflected in your P&L. So how does that compare? How does that exactly come out? Well, the thing is, every option has its own implied volatility. And you want the option that you own to keep its implied volatility, or maybe even go higher, because the more IV that it has, the more it will be worth. So you don't want something that you bought that you're long to lose its volatility, and you'd prefer something that you sold, like the 60.40 for the 13th, to lose its volatility, because then it'll be worth less. Now, the thing of it is, this trade can still work even if, say, they both went up 2 points. The trade can still be fine. What hurts this trade is if the short volatility goes up more than the long. So let's say the short went up a point in IV and your long just laid there. Well, that's going to come out against you at about 66 bucks. But generally speaking, if the volatility of the market, the VIX, in this case, we're using the SPX, if the VIX goes up, generally speaking, that's going to be good for your calendar, because most of the time, the further out options are more sensitive to IV changes. So it's most likely going to be the benefit of that. So if you see the VIX is rising, that's probably good for your trade. If the VIX is dropping very much, that can be harmful to your trade, but we certainly can take some drop without it ruining the trade, of course. So let's go back over here and look at the graph. Now, another thing I want to point out is, you notice I did 4 days wide. You've probably seen me in the past do 3 days wide. The reason I do this, when we're under 15, I'll go 4 days wide, is because when you're wider, you get a little bit more volatility exposure, meaning if volatility does go up in your favor, you'll make a little more money. Look at 66.48. And if I just do 3 days wide, it's 50 bucks. So we're gaining about $16 a point in IV profitability if it goes up in our favor by being 4 days. Now you'll also notice that 3 days is $2.60 for the spread, and 4 days is $5. Still, these trades are not very expensive compared with, say, if you looked at these trades whenever the VIX is higher, you'll pay a lot more for these trades. When your VIX is lower, these do cost you less, but the beauty of buying them whenever they're lower, if the volatility would firm up a little, maybe you put it on at 13.5, maybe go back into even just get over 15, this can really help you in the calendar. That little pop in volatility can actually help you get out of a trade fairly quickly. I've been out of them in 2 hours. I've been out of them in a few days, a day or two. Just recently, I was out of one, and I think it was a day, just because volatility was favorable to us. So keep that in mind. That's why I like these down here. That's why I like doing them 4 days wide. And I think if you do it anywhere around the money, if you want to be a little above the money, you can. If you want to take more chances, you could even put it further above the money, however you want to play it. Now, another thing here that I want to show you is, what if I did this trade for this Friday? You say, Mark, I want something really fast. Well, let's take a look at what it would look like. So if I did the same strikes as far as 60-40, lower break even, $97 down. Upper break even, $7.50 down. 97, $7.50. What if I move this whole thing up a week? So selling this Friday, and then buying 4 days wide the 10th. Now the trade for one costs us more. Our theta is 123. We'll compare that when we go back to the other. It's going to be higher. But now with the lower break even, look, I'm down 150 bucks. Upper break even, I'm down 50 bucks. So you can see that there's a little more danger on the edges if you do something shorter term and you pay more for it. Now, what do I get for that? Well, I got higher theta, 123, the VIG is 94. Now, if we go back to what we were doing, and what I would do is the 13th and the 17th. Now the theta is 38 bucks, Vegas 66. So things are definitely different, but I like this trade because even though it's further out, time decay may be a little slower, you can still fairly easily, unless the market really moves hard against you, be out of this trade by this Friday at 8 or 10%, which would be my profit goal. So that's why I like to do that, because you can still get out of it, in a 4 or 5 days. It might take you longer sometimes, but it's a possibility you can do this. And you also don't take the chances on the edge. If it does get to running hard up against us, we won't be down as much money as if it was this Friday. Not only that, what if we needed to repair this trade? Now, if you have to repair this trade, it's going to be a lot easier if you have more time. I don't normally like to say add a complex for a repair after Tuesday of expiration week. Well, that would mean you put this on tomorrow. The next day is about it for you. If it starts running wild on you Wednesday, Thursday, it's probably too late to really repair it effectively. But if you do it for next Friday, the 13th, you have plenty of time to repair that trade. So that's why I like this time frame. That's why I like it 4 days wide. And that's why I like calendars when we're down here under 15 in general. So I've kind of laid it all out there for you. By the way, you can do this trade in ES. You can do this trade in SPY if either of those are more to your liking. I trade the SPX mainly myself. Once in a while, SPY or ES. But I like to follow just one thing, like the S&P. It's blended pretty well, and you don't have single stock risk. That's why I just do SPX trades, really. Counters, diagonals, flies. Pretty much what I do for almost all of my trading. A few spec plays here and there on things. but generally all in SPX. I did, by the way, I just finished my course last week on back ratios and directional flies and time bomb flies, all in one course. And I finished it, but because it's a holiday week, we don't have it edited and up for on the Aramer site yet for sale. But I hope to get it up there by the end of this week and announce probably some kind of a holiday sale in general here by the end of this week. But check out my links in the description. You can see what's going on with the different classes. And then I also have Opening Bell Traders Lounge and my Trade Alert service. Now, those won't be going on sale, but the classes most likely will. So, but if you want to be with me every day, see what we're trading, follow me live on trades, then check out the links there in the description. I also appreciate if you hit the like and subscribe to this YouTube channel. It is really, the hours watched has really taken off a lot, folks. The folks are watching a lot more of what I'm doing. I appreciate that. Please tell your friends. I'll be back here next Sunday. Let's see what this week gives us. Hey, maybe we'll still be in calendar territory by the time we meet again here. So I'll talk to you then. Have a great week. Bye-bye.